Hi, welcome back to Making Sense of It All video blog series. Today we'd like to talk to you about what moves the market. Although there are many variables, and some of those variables may include what political events are doing not only domestically but internationally. It could be commodity prices, it could be bond prices, it could be currencies, what currencies are doing, it could be what bonds are doing, it could be doing what weather patterns are doing, it could be investor psychology, it could be money flow, it could be economic releases, but what we really think are one of the key variables is earnings, and earnings moves a market not only up but down. Last week we saw some upside surprises with a number of economic releases, and we saw a jobs report that was better, we saw domestic auto sales were better, the ISM number was better, and what we watched as the market continued to move upward. Last week the Dow and the S&P were up and closed 1.3% up, and the NASDAQ, which was much stronger, closed up about 2%. We talked about in the past and written posts about earnings and how important it actually is not only to the market but also investor psychology. And what we think is this upcoming earnings season, which would be the second quarter earnings season, could show some upside surprise. And if that takes place, we may actually see double-digit earnings growth, which would be the first time that that's happened in approximately 3 years. We think if this happens that we could see quite a move up. Reuters, by the way, is calling for this quarter to be up 6.2% for the second quarter. And they're expecting the third and the fourth quarter to show double-digit earnings growth from the standpoint of the overall market. If we watch earnings accelerate to close to 10%, we think that there could be a possibility of a melt up in the market. And we think that that would catch a lot of people flat-footed. We think that they'd have to put cash back into the market in a relative quick fashion. And we think that the expectations for growth looking out would also improve. What we'd like to talk about are some of the reasons why we're seeing that or suggest that that could take place. One of the things that we look at are earnings surprises or pre-releases. What is interesting is the negative earnings pre-announcement for companies have shown the most positive skew in over 6 quarters. Of 133 companies that have made pre-announcements from the S&P, 97 have been negative, 24 positive, and 12 in line with existing forecasts, according to Thomson Reuters. That puts the negative to positive ratio at 4-to-1 for the second quarter. This is the lowest since the fourth quarter of 2012. In addition, companies last quarter, comparing to a 5.9-to-1, which was higher, and then also 5.5-to-1 a year earlier. So the bottom line is we're seeing less negative correlation in terms of earnings surprises, which in essence is a positive surprise. The second thing that we found very intriguing was the actual growth that companies suggest that they can do, meaning their outlooks tend to be very conservative. And this has actually taken place since the recession that we had. Since 2009, after the completed earnings period, what we found is that each of the quarter cycle exceeded the growth forecast at the start of the quarter by almost 5%. Let me repeat that. After an earnings period, what people thought the earnings would be, they were 5.7% higher at the end of that earnings season. That is being conservative from the standpoint of where companies believe that their earnings could turn out. The point of this is that last quarter, the street was looking for a 2.1% increase in earnings from the S&P 500 companies, and what we watched when everything was said and done was a 5.6% return in earnings growth. That's a 3.5% differential. And that 3.5, if you add that on to what we're currently looking for Reuters, you are currently close to a 10% return as far as earnings. Currently, the Dow, very close to closing on Thursday, was trading at about 15.6 times forward numbers. This is the highest it's been in 9 years. So the point that we have here is, should we see some earnings acceleration happen quicker, this would be a very welcome sign to market participants as well as pundits. For the information, we'd really like to thank Angela Moon from Reuters. We also want to talk about one last thing. If we do see that double-digit earnings growth, we could watch what I think could be is a melt up in the market. That would, in my opinion, be a welcome surprise. It would truly show some fireworks in the market. And what we think could happen is that investors would say and suggest that the market is not as expensive as many people think it is. Again, we do these video blogs from the standpoint of trying to give our current thoughts to the market and to stocks. And with earnings season coming up and earnings starting Tuesday with Alcoa starting, we will definitely be on the lookout to see whether or not double-digit earnings growth can happen this quarter. We welcome any comments or questions. Please feel free to give us an email at mneedleman@fusioninvest.com. And again, thank you for coming back and have a great day.